Hey, VA-backed home loans just hit a 10-year high. Nearly 8% of every mortgaged home purchased in the 40 largest metro areas last quarter was a veteran using their VA loan benefit. That's the highest share the program has seen in over a decade. At the same time, the VA quietly rewrote the appraisal rules that have been slowing veteran buyers down for years. This is happening right now, and almost nobody who's making these videos talks about the part that actually matters. Most veterans using this benefit are leaving six figures of wealth building potential on the table because they think a VA loan means one house, one family, one shot. Well, it doesn't. Stick with me for the next few minutes. I'm going to walk you through exactly what changed, what it means for your next purchase, and where I watched good veterans make an expensive mistake with this benefit. Before we get into it, do me a favor, hit like, subscribe, and tap that notification bell. I put out real estate content for veterans and first responders 3 times a week with no fluff, no hype, just what really works. I spent 35 years in the Air Force, 13 years as a police officer. I served as mayor of Sentiments in New Jersey. Today, I'm an active real estate investor across 4 states focused on single-family and small multifamily properties. I mentor veterans and first responders getting into this business, and I founded a low-cost property management company built for investors by investors, not corporate landlords, in South Jersey. Here's what most veterans believe about the VA loan. They believe it's a one-time benefit for buying a single-family home. Get out, use your entitlement, buy a house, move your family in, done. That's the extent of the plan for a large number of people who come through my program. And on the surface, that's not wrong. The VA loan does help you buy a primary residence with 0 down, no PMI, private mortgage insurance. It is one of the best financing tools available to any veteran buying a home in this country. The problem is that what that belief leaves out is a VA loan is not limited to single-family homes. You can use the exact same 0 down benefit to buy a duplex, triplex, or a fourplex as long as you wouldn't live in one of the units. Same funding fee structure, same no PMI, same underwriting benefit. The only requirement here is owner occupancy. You got to live there. And the VA is flexible on how fast you can move in and how long you have to stay. Most veterans never hear this from their loan officer because most loan officers are moving volume on single-family purchases, and multifamily deals take more work to close. So here's the rising problem. The veteran uses their full entitlement on a single-family home. Maybe it's a starter home. Maybe it's exactly what the family needs at that point in life. 2 years later, though, that veteran wants to get into real estate investing. They come to me. They're excited, and I have to tell them the truth. Their VA entitlement is tied up. They have too much in it. They can still use a second-tier entitlement in some cases, but now they're dealing with conforming loan limits, higher funding fee. Sometimes they have to bring more money to the table for a down payment requirement, depending on the country or the county that they're buying in. A 0 down, no PMI advantage they had access to on day one might be gone or severely limited. They had one shot to buy a property that generated income, and they covered their own housing costs at the same time, and they use it on a straight single-family purchase with no rental income offsetting their mortgage. That's not a small mistake. Let's run the math. A veteran buys a fourplex with 0 down using their VA loan. They live in one unit. The other 3 units, say $1,400 a month each. That is a $4,200 per month in rental income covering a mortgage that might run maybe $5,000 to $6,000 max on the property. The veteran's living close to free, if not free, sometimes. So while 3 tenants are paying down the mortgage and build their equity, compare that to a veteran who buys a single-family home with the same 0 down benefit. They cover the entire mortgage themselves, no offsetting income, no equity acceleration from tenants, and their entitlement is spent either way. Same benefit, 2 completely different financial outcomes 5 years down the road. The conflict here shows up when that first veteran, the one who bought single-family property, tries to catch up later. They're now trying to acquire an investment property using conventional financing, which means 20, 25, sometimes 30% down on a multi-unit property. That is $60,000 to $80,000 in cash for a property that they could have got for $0 down 2 years earlier. Some of them get discouraged and give up on investing. I've seen it. A veteran with the discipline and the credit to build serious wealth through real estate, they walk away from the whole doggone idea because they think they missed their window. They didn't. They just didn't know the rules of the benefit that they had already used. So look, if you're a veteran and you're watching this and you haven't made your first purchase yet, or you're eligible for a second use of your entitlement, this is exactly the kind of decision that we'll help you with at the War Room with David Perret. The War Room was built to help you work through these kinds of problems, a community of veterans who are actively engaging in real estate, asking these questions before they make the purchase instead of after. I'm in there, and I've been there since December of 2019, and it's contributed to my success. Check the link in the description. If you want one-on-one coaching specific to your situation, Just book a call with me at buddevans.com, but the war room is where I want every veteran starting out to plant their flag first. Now, let's talk about the turning point in the system that fixes this. Before you apply for another VA loan, ask one question. Not, can I afford this house? Can this property carry itself with a rental income if I put tenants in the other unit? That question changes everything with those properties that you look at, which neighborhood you search for, and which loan officer you're going to want to work with. So here's the correct operational approach. First, find a lender who actually closes multifamily VA loans regularly. Not every loan officer has done one. Ask directly how many 2 to 4 unit VA transactions they've closed in the last 12 months. If the answer is none, or they hesitate, find somebody else. Second, understand the appraisal changes the VA just made. As of July, the VA updated its minimum property requirements around radon testing, pre-1978 lead paint standards, detached structures, and non-vented heating units. These changes are made specifically to cut down on appraisal delays and fallout, which historically has been one of the biggest reasons VA offers get rejected by sellers in competitive markets. That means multi-unit VA offers, which used to scare sellers because of an appraisal timeline fears, are now more competitive than they were even a year ago. Use that. When your agent writes an offer, make sure it references the current MPR guidance so the listing agent knows that this is not the VA process they remember from 5 years ago. Third, run the numbers on rent coverage before you make the offer, not after. Pull comparable rents for the other units using an actual listing in that zip code, not a guess. Your target here is for the non-owner occupied units to cover 75% or more of the total mortgage payment, including taxes and insurance. If you can hit that number, you're in a strong position regardless of what happens to your income down the road. The goal here, though, is to offset all of your mortgage. Fourth, know your funding fee math before you commit. First, use with zero down runs, 2 points, 5% of the loan amount. That fee is now tax deductible, which for 2026 and worth factoring into your numbers. If you have used your entitlement before, your fee jumps to 3.3% unless you qualify for an exemption through service-connected disability ratings. Fifth, and this is the one mistake I see most often, do not let a real estate agent talk you into a single-family home because it's easier to show and easier to close. Agents who do not specialize working with veteran investors are going to steer you towards something that is a simple transaction because, let's face it, it's less work for them. That's their incentive, not yours. Interview your agent the same way you interview your lender. Ask how many multi-unit deals they've closed for veteran buyers. Ask them how many veteran buyer investors that they're currently working with. Hey, let's recap what you need to walk away with today. 1, confirm your VA entitlement status and whether you're eligible for full or second-tier use before you even start looking at properties. Then find a lender who has closed multi-unit VA transactions in the last 12 months and ask them directly, how many? Target 2 to 4 unit properties where rental income from non-owner occupied units can cover 75% or more of the total mortgage. Remember, we're looking for up to 100% here. Next, pull real comparables, pull real rent comps for the market before writing the offer, not after. Next, understand the new July 2026 minimum property requirement changes on radon, detached structures, and pre-1978 lead standards so you know what will and will not hold up on your appraisal. Then calculate your exact funding fee based on first use versus subsequent use and check whether a service-connected disability exempts you from that fee. Interview your real estate agent specifically on multi-unit experience with veteran buyers before you sign their buyer agreement. Don't get stuck. If you are serious about using this benefit the right way, hit the like, subscribe, and that notification bell so you catch the next video walking through how to actually structure an offer on multi-unit VA purchases. Thanks for watching. I'm Bud Evans. Aim high, execute fast. See you on the next one.